Welcome to i-TUTOR Economics NCERT series. We were studying Chapter 6, Banking, and yesterday we studied commercial banks, their functions, credit creation, primary and derived deposits, and the role of banks in economic development of a country. Today we will start a new topic, that is Central Bank. So let's start with the topic Central Bank. A central bank is the main bank of a country that manages the nation's currency, controls the money supply, and regulates interest rate. It also supervises and oversees the functioning of commercial banks in the country. So we are going to learn about the Central Bank of India, which is called the Reserve Bank of India. So think of RBI as the boss of all banks in the country. It controls the money in the economy and keeps everything running smoothly. Let's see what RBI does. So what are the functions of central bank? So first thing, monetary authority. Imagine the economy as a big water tank and money is the water. Too much water, that is money, can flood the tank. That means it will cause inflation, and too little can dry it up. In economics, we say it as recession. So the RBI controls how much money is flowing in the economy to keep it balanced. So this is what monetary authority means. Then, issuer of currency. RBI is the only place that can print Indian money. No other banks or person can make currency notes. It also keeps an eye out for fake notes to protect us. Okay. Then, banking license authority or issuer of license authority. What does this mean? Before any new bank opens in India, it must get permission. That means license from RBI. This is to make sure all banks are trustworthy and follow rules. So, in short, RBI is like the captain of the ship of India's economy. It manages money, issues currency, and regulates banks to keep the economy safe and stable. Okay, then banker to the government. So RBI acts like a personal banker for the central and state governments. It provides short-term loans. Okay, it provides short-term loans whenever the government needs money. And it manages government debts and issues new government loans. It helps in developing the market for government securities. Then, it advises the government on financial and banking matters. For example, think of RBI as a financial advisor and wallet manager for the government. Okay, so this is about banker to the government. Then RBI is also known as Bankers Bank. Why? Because it provides loans to commercial banks, accepts deposits from them, and rediscounts their bills. Okay. Then, for example, just like a head office supports all its branches, RBI supports all banks in India. Then, lender of last resort. That means in times of crisis or emergency, when banks cannot get money elsewhere, they can borrow from RBI. They give eligible securities as collateral to the RBI to get this emergency loan. For example, think of RBI as a friend who lends money when everyone else say no. Okay. Then, it acts as clearinghouse. RBI manages 14 clearing houses in India. It helps banks settle transactions efficiently. Also, it facilitates the exchange of checks, drafts, and payment instructions between the banks. For example, imagine RBI as a post office where all banks send their money related messages to ensure smooth delivery. Okay, then RBI acts as the custodian of foreign exchange reserves. What does this mean? Yes, RBI acts as the guardian of India's foreign currency reserves. It manages and enforces FEMA. FEMA means Foreign Exchange Management Act. So it manages and enforces FEMA 1999. Also, it buys and sells foreign currency to stabilize the exchange rate of Indian rupees. For example, think of RBI as a vault keeper who ensures India has enough foreign money and keeps the rupee stable. Okay, then regulator of economy. That means RBI controls money supply in the system. It monitors key economic indicators like GDP, inflation, and employment. For example, RBI is like a doctor checking the vital signs of the economy to keep it healthy. Okay. Now, managing government securities. That means RBI administers investment in government securities. It ensures financial institutions invest the minimum portion of their assets in government securities. For example, RBI is like a portfolio manager guiding banks on where to safely invest. Okay, then RBI is the regulator and supervisor of payment and settlement system. That means it oversees payment and settlement systems under the Payment and Settlement Systems Act 2007. It ensures safe, secure and efficient payment system in the country. For example, RBI is like the traffic controller for all money transfers, making sure there are no jams or errors. Okay, then developmental role means it develops a strong banking system and ensures credit flows to productive sectors. Then it supports national objectives and builds financial infrastructure. Then it promotes financial inclusion, literacy and affordable banking services. For example, RBI acts as a mentor, guiding banks and helping India's economy grow steadily. Okay. Then publisher of monetary data and other data. That means it maintains and provides essential banking and economic data. Then it helps in formulating and evaluating economic policies. Then yes, that's enough. For example, RBI is like a research hub that gives policymakers the data they need to take informed decisions. Okay, and the next function, it acts as an exchange manager and controller. RBI represents India in IMF, that is International Monetary Fund. Commercial banks act as authorized dealers of RBI for foreign exchange operations. For example, think of RBI as India's ambassador in the global money market, managing foreign exchange and representing the country. Then, Banking Ombudsman Scheme. It was introduced in 1995. It allows customers to file complaints against banks for unfair practices. And complaints can be online or offline, and customers can appeal to the ombudsman if not satisfied with the bank's decision. For example, RBI acts like a referee. RBI acts like a referee, resolving disputes between banks and their customers. Then, Banking Codes and Standard Board of India. RBI establishes BCSBI. That means Banking Codes and Standard Board of India. So RBI established BCSBI to ensure that banks follow standardized codes and practices, and it helps measure the performance of banks and ensures they maintain fair and transparent operations. For example, think of BCSBI as RBI's quality check team, making sure banks follow global best practices. Okay, so these are the functions of RBI. Okay, what are the functions? What are the functions of RBI? Yes, it is a monetary authority, issuer of currency, issuer of banking license, banker to the government, then bankers bank, lender of last resort, acting as clearing house, regulator of economy, managing government securities, regulator and supervisor of payment and settlement system, then developmental role, publisher of monetary and other data, exchange manager and controller, banking ombudsman scheme, then banking codes and standard board of India. Okay, so hope it is clear for you. Now we are going to learn about the Reserve Bank of India, that is central bank of our country. First, let's look at the history of RBI. RBI was formed on 1st April 1935 under the RBI Act of 1934. Later, it was nationalized on 1st January 1949, which means it became fully owned by Government of India. Initially, the headquarters was in Calcutta, but in 1937, it was shifted to Mumbai. The first governor, do you know who was the first governor of RBI? Yes, the first governor of RBI was Osborne Smith. So remember the key dates: 1935, then 1934, RBI Act 1934, then 1949, 1937. Okay, so this is about the history of RBI. Now, administration. RBI is the Central Bank of India, which means it regulates all banks in the country. It is also called the lender of last resort because when other banks face a shortage of funds, they can borrow from RBI. The bank is managed by a governor, 4 deputy governors and a central board of directors, all appointed by the government of India. So think of RBI as the head of all banks in India. It supervises them and helps them in emergencies. So this is about administration of RBI. Now, what about the functions of RBI? We have already told it. What are the functions? Issuing currency, that is RBI is the only authority that can print Indian rupees and manage the currency systems. Then, banker to the government. That means RBI manages all receipts and payments for the central and state governments. Then, regulator of banking system. What does this mean? It controls and supervises all commercial banks to make sure the banking system is safe. Then custodian of forex. Forex means foreign exchange. RBI manages India's foreign currency reserves and keeps the exchange rate stable. Then controller of credit. It controls the money supply in the economy to manage inflation and growth. So remember, RBI prints money, manages banks, helps the government control credit and protects foreign exchange. In short, we can say that RBI is like the heart of India's economy. It keeps everything flowing smoothly, whether it is money, bank or the economy itself. Okay. And now the process of issuing paper currency in India started in the 18th century. At that time, private banks like Bank of Bengal, Bank of Bombay and Bank of Madras were the first to print paper money. First to print paper money. So initially it was not the government but private banks that issues notes. The first rupee was introduced by Shershah Suri. Okay, Shershah Suri. It was based on a ratio of 40 copper pieces or paisa, that is equal to 1 rupee. The word rupee comes from the Sanskrit word rupiah, which means silver. So the word rupee comes from the Sanskrit word rupiah, which means silver. Today, each Indian banknote is written in 17 languages. In front page, there is English and Hindi, and back 15 other official languages of India. This shows the diversity of our country. So the key takeaway is that currency in India has a long history, starting from coins by Shershah Suri to private banks issuing paper money, and now modern banknotes representing India's linguistic diversity. So hope you understand. Now we are going to discuss credit control measures of RBI. So what is meant by credit control? Credit control is the main tool used by RBI to manage money supply in the economy and achieve its monetary objectives. It helps the RBI control inflation, deflation and overall economic stability. The RBI has a strong legal basis for the credit control through Reserve Bank of India Act 1934 and Banking Regulation Act of 1949. So let's look at some methods of credit control. Let's look at some quantitative methods. Okay, so these methods are used to control the overall supply of credit in the economy. They are called general. Why? Because they affect all sectors uniformly. The main tools are bank rate policy and open market operations. Main tools are bank rate policy and open market operations. Other include variable reserve ratios like cash reserve ratio and statutory liquidity ratio. So what is meant by bank rate policy? The bank rate is the rate at which central bank is willing to give loans to commercial banks against approved societies. Remember, the central bank is the lender of last resort. So its rate is usually higher than the market rate. How it works? Yes, if the central bank wants to reduce credit in the economy, it raises the bank rate. So what happens? Borrowing from banks become expensive, lending rates go up, credit contracts and inflation is controlled. If the central bank wants to increase credit, what will they do? They will lower the bank rate, and the result is that borrowing becomes cheaper, credit expands and economic activity is encouraged. Okay, I'll tell you an example. Suppose RBI raises the bank rate from 6% to 8%. Commercial banks now have to borrow at 8%. They raise lending rates for borrowers and people borrow less, money supply in the economy reduces. That's about bank rate policy. And what is meant by open market operations? Open market operations or OMO? OMO refers to the buying and selling of government securities by the central bank in the money market. In a broader sense, it can also include other eligible securities like private bill and corporate bonds. So, do you know how it works? People and bank pay cash to buy them. Money leaves the system, liquidity reduces and credit contracts. So central bank buys securities, what happens? It pays monies to the seller, then liquidity increases and credit expands. So the key point is that through OMO, the central bank controls the flow of money in the market, either encouraging or restricting borrowing and spending. Hope you understand. Now, variable reserve ratio. So this is the method by which the central bank controls the amount of credit that commercial banks can create. It has two parts. What are they? Cash reserve ratio, CRR, and statutory liquidity ratio, that is SLR. So what is meant by cash reserve ratio? So CRR is the percentage of a commercial bank's total deposits. Total deposit means demand and time deposits are included. So it is the percentage of a commercial bank's total deposit that it is required to keep with the central bank in the form of cash. Remember the word, in the form of cash. So what is the purpose of keeping CRR? It ensures that banks maintain a certain reserve and also allow the RBI to control credit flow in the economy. Do you know how it works? If banks are creating too much credit, which may lead to inflation. When inflation happens, RBI raises the CRR. Banks must keep more money with the RBI. Then lending capacity of banks therefore reduces and credit contracts, money supply in the economy falls. Now, what if RBI wants to encourage economic growth? What will they do? They will increase or decrease or lower the CRR. They will lower the CRR, so that banks have more money to lend and that leads to an expansion in the credit and economic activity increases. So the idea of variable CRR was first suggested by J.M. Keynes. Who suggested it first? J.M. Keynes. It was first implemented by the Federal Reserve System in the USA. So high CRR means less credit creation, low CRR leads to more credit creation. Now, do you ever heard the term SLR or statutory liquidity ratio? What does this mean? Yes, SLR is the percentage of a bank's net demand and time liabilities. Net demand and time liabilities. NDTL, net demand and time liabilities, that the bank is required to keep in the form of cash, gold or approved government securities. Why we are keeping SLR? What is the purpose of keeping SLR? SLR ensures that banks maintain a certain level of safe and liquid assets to back their deposits and help RBI indirectly control credit in the economy. So what is the main difference from CRR? Yes, the CRR is maintained with RBI cash only, okay. But SLR we can use cash, gold or anything. But the purpose is to direct control of credit, indirect control and liquidity management. High SLR leads to high SLR means banks have less money to lend and that will lead to a contraction in credit. And low SLR means banks have more money to lend and that leads to an expansion in credit. That's about SLR and CRR. So these are the quantitative measures to control credit. Bank rate policy, open market operation, then variable reserve ratio and also other variable reserve ratio we have CRR and SLR. Now we are going to learn about qualitative or selective methods of credit control. Okay. So unlike quantitative methods which control total credit in the economy, qualitative methods aim to control the direction or purpose of credit. And the objective is to prevent misuse of credit and channel funds to priority sectors while restricting credit for speculative or harmful purposes. So the main selective methods are rationing of credit, direct action, moral persuasion, method of publicity, regulation of consumer credit, regulating the marginal requirements on security loans. So let's learn it one by one. Rationing of credit. The RBI may limit the amount of credit given to specific industries or sectors that are causing inflation or speculative activity. For example, if real estate prices are rising too fast, what happens? Banks may ask to reduce lending to property developers. Okay, that is about rationing of credit. Now, direct action. RBI can take direct measures against banks or borrowers who violate lending norms. For example, penalizing banks for giving excessive loans to non-priority sectors. Now, what about moral suasion? RBI may pursue banks through advice, guidance or warnings to control lending behavior. So this is done without legal compulsion. It relies on trust and cooperation. Okay, then method of publicity. RBI can make public statements or releases about certain lending practices to influence public and bank behavior. For example, announcing higher risk sectors where banks should avoid excessive lending. Now, what about regulation of consumer credit? RBI can restrict loans given for consumer purposes, especially for goods bought on hire purchase or easy installment plans. And the objective is to prevent excessive spending that may fuel inflation. Okay, now regulating the marginal requirements on security loans. So RBI can change the marginal requirements on loans against securities like shares or golds. High margin means that leads to lower credit availability. Then lower margin leads to higher credit availability. So the key idea is that quantitative methods is used to control total money supply and qualitative methods is used to control the direction and purpose of credit. So this is the main idea. So let's look at it one by one in a detailed way. So rationing of credit. It is the oldest method of credit control, first used by the Bank of England in the 18th century. And the purpose was to control and regulate the purposes for which commercial banks give loans. So two main types of rationing of credit are there, the variable portfolio ceiling and variable capital asset ratio. Variable portfolio ceiling. The central bank sets a maximum limits on the total loans and advances a commercial bank can give. It helps prevent banks from giving excessive credit that could lead to inflation or speculation. Now, what about variable capital asset ratio? The central bank fixes the ratio between a bank's capital and its total asset. This ensures banks do not over leverage themselves and take excessive risk while lending. So this is about rationing of credit. Now, direct action. The central bank can take direct measures against bank violating credit norms. So the forms of direct action includes refusing to provide discounting facilities to the erring bank, then refusing to sanction further loans or financial assistance if the bank's borrowing exceeds its capital and reserves, then charging a penal rate of interest on money borrowed by a bank beyond the prescribed limit. So the key idea is that rationing ensures credit is given for the right purpose while direct action penalizes banks that misuse credit. Okay, now moral suasion. So it is frequently used by the central bank to control credit. How it works? The central bank advises, requests and persuades commercial banks to follow its credit policies. No legal force, it works on trust, cooperation and influence. For example, RBI asking banks to limit loans to speculative activities or prioritize lending to productive sectors. Now, publicity. What is the purpose? To create public awarenesses and support for central bank policies. How it works? Policies of central bank are publicized in the media to shape public opinion. When the public understands and supports the policy, commercial banks are more likely to cooperate. For example, announcing measures to control inflation or promote agricultural credit. And the key idea is that moral suasion and publicity are non-coercive methods. They influence banks and the public indirectly rather than enforcing rules by law. Okay. Now, regulation of consumer credit. The objective is to control the flow of credit for consumer purchases like durable goods. How it works? It increases the down payment required from consumers. Then, it reduces the number of installments allowed for repayment, and the effect is that it makes consumer credit more expensive and less attractive, which reduces the unnecessary borrowing and helps control inflation. Then, changes in marginal requirements on security loans. It is mostly followed in USA, especially to control stock market speculations. How it works? The Board of Governors of Federal Reserve sets the margin requirement for loans taken to buy stocks, and margin requirement is equal to the minimum portion of the price that an investor must pay in cash while the rest can be borrowed. And the purpose is to prevent excessive borrowing for speculation in the stock market and also to help the central bank control the volume of credit used in security markets. And the key idea we should remember is that both these methods are selective or qualitative measures. They target specific sectors or types of borrowing rather than controlling credit in the economy as a whole. Okay. Now, do you know about RBI's repo rate and reverse repo rate? What does this reverse repo rate and repo rate means? So let's look at it one by one. Repo rate. Repo rate is the rate at which commercial banks borrow money from the RBI when they face a shortage of funds. And the purpose is to control liquidity and inflation in the economy. So if the RBI increases the repo rate, borrowing becomes more expensive for banks. Banks will then borrow less, reducing the money supply in the economy and helps to control inflation. If the RBI decreases the repo rate, borrowing is cheaper, banks borrow more, increases money supply, and it leads to a useful in a deflationary situation. And what about reverse repo rate? It's the opposite of repo rate, the rate at which RBI borrows money from the commercial banks, and the purpose is to absorb excess liquidity from the banking system. What is the mechanism? Yes, if the RBI increases the reverse repo rate, banks are encouraged to park more money with the RBI because they earn higher interest. And this reduces the money available with the banks for lending to customers, and it helps to control inflation. If the RBI decreases the reverse repo rate, banks are less incentivized to park money with the RBI. And more money is available for lending, and it helps in economic growth or deflation control. So repo rate means RBI lends to bank. Reverse repo rate means banks lends to RBI. So both are tools to regulate liquidity and control inflation or stimulate the economy. Okay. Now we are going to learn about Reserve Bank of India and the rural credit. Okay, in a developing country like India, the role of RBI goes beyond just controlling money supply and inflation. The RBI also plays an important part in economic development, particularly in supporting agriculture and rural sectors. So the key points are, it is beyond monetary regulation. RBI is not limited to just controlling liquidity, inflation or interest rate. It also works to ensure that credit reaches sectors that need it most, like rural areas and agriculture. Then a rural credit development. That means many farmers and rural businesses do not have easy access to commercial banks. So RBI promotes credit flow to rural areas through specialized institutions like regional rural banks, cooperative banks and agriculture finance programs. And do you know what is the purpose? The purpose is to support agricultural production, rural entrepreneurship and small-scale industries to ensure inclusive growth so that development is not limited to urban areas alone. So, I'll tell you an example. If a farmer needs a loan for buying seeds or machinery, RBI ensures that financial institutions provide these loans at reasonable rates. So, farming activity continues smoothly and contributes to the economy. Okay. Now, we are going to learn about role of RBI in agricultural credit. In India, agriculture plays a crucial role in the economy, employing a large portion of the population. However, farmers often face difficulty accessing formal credit from banks and financial institutions. This is where the RBI steps in. So, RBI has been crucial in ensuring that adequate funds reach the agricultural sector. It recognizes that agriculture is predominant in India and requires special attention. Okay, then setting up agricultural credit department is another function. What does this means? To manage and promote agricultural lending, RBI established a separate agriculture credit department. This department coordinates policies, credit targets and monitoring to improve rural lending. Then, addressing gaps in formal credit. This means despite these efforts, informal loans from moneylenders still exist in rural areas. RBI continuously works to expand the reach of formal credit to reduce dependence on informal sources, which are often costly for farmers. So think of RBI as the backbone of agricultural finance. It not only sets policies for banks to lend to farmers, but also monitors and facilitates lending through specialized departments. The goal is to make sure farmers get affordable loans rather than relying on expensive money lenders. So what are the functions of Agricultural Credit Department? The Agricultural Credit Department was set up by RBI to focus on agricultural finance and rural development. Okay, and the key functions are: the department maintain a team of experts to analyze and study all matters related to agriculture credit. Then it have an advisory role. That means it provides guidance and advice to central and state government, state cooperatives and other banking institutions. Then financing and coordination is also a role. That means it helps in financing the rural sector through eligible banks and cooperatives. So coordinates the activities of institutions that provide agricultural loans. Okay, then this RBI did not lend directly to farmers. Rural credit flows work through a refinance mechanism. That means farmers borrow from primary cooperative societies. Farmers borrow from primary cooperative societies. These societies borrow from central cooperative societies. Okay, and this central or state cooperative banks in turn borrow from RBI. And the purpose of medium-term loans, that's it, 15 months to 5 years, is that land reclamation, then construction, irrigation construction, purchase of machinery, etc. And the long-term purpose is permanent improvement in land and redemption of old debts. So in 1982, the National Bank for Agriculture and Rural Development, that means NABARD, National Bank for Agriculture and Rural Development, it took over all agriculture credit functions from the RBI. Since then, NABARD handles all rural credit activities including refinance and policy implementation. So think of RBI as the original architect of rural credit, designing systems and supervising institutions. NABARD later became the dedicated executor, taking over all operational responsibilities for agriculture finance in India. Okay, now we are going to learn about Agricultural Refinance Development Corporation or ARDC. Why ARDC was needed? Yes, farmers in India require medium-term and long-term loans for activities like land improvement, irrigation and purchasing machinery. However, access to such credit was limited. Land development banks were the only source of long-term loans. These banks lagged behind and had limited success in meeting farmers' growing financial needs. The credit demand of the agriculture sector was increasing year by year, creating a significant gap in agriculture finance. And the purpose of ARDC is to bridge gap in agriculture finance, then provide medium-term and long-term loans for projects involving agriculture developments, then support initiatives like irrigation projects, land reclamation, mechanization and other agriculture-related investments. And how it formed and what is its function? Yes, it is established by an Act of Parliament, then started functioning from 1st July 1963. Then it acts as a refinancing institution for other agriculture banks and financial institutions, helping them extend credit to farmers more efficiently. So think of ARDC as a supporter system that strengthens other agriculture banks so they can reach farmers with medium and long-term loans that were otherwise difficult to get. Okay, so the objectives of ARDC revolve around providing financial support to institutions that lend to farmers. So these are ARDC, first one, refinancing eligible institutions. That means ARDC provides necessary funds to eligible institutions including central land development banks, state cooperative banks, scheduled commercial banks and so on. And this ensures that these institutions have enough resources to extend medium-term and long-term loans to farmers. Then subscription to debentures. What does this mean? ARDC buys debentures issued by the above banks provided these debentures are approved by the RBI. This injects capital into these banks, enabling them to lend more effectively to the agricultural sector. So think of ARDC as a financial support bridge. It doesn't directly lend to farmers but ensures that the bank which do lend to farmers always have enough money to meet their credit requirements. Okay. So now let's move to next topic, that is regional rural banks or RRBs. Okay. During the emergency period, Mrs. Indira Gandhi launched the 20-point economic program. One of the key objectives was to reduce rural indebtedness and provide institutional credit to farmers, artisans and rural entrepreneurs. In line with this, the Government of India established regional rural banks in 1975. And how is the ownership structure? Central government 50%, state government 15%, then sponsoring commercial banks 35%. So RRB's aim is to provide credit and other banking facilities to the following groups. Which all groups? Small and marginal farmers, then agricultural laborers, artisans, small rural entrepreneurs and so on. And the goal is to promote agriculture, trade, commerce, industry and other productive activities in rural areas. So think of RRB as friendly neighborhood banks in rural areas. They are specifically designed to reach small farmers and rural artisans who often cannot access big commercial banks easily. Now, what are the concessions to RRBs? First, support from sponsoring banks is there. Okay, that means managerial and financial assistance. That is, sponsor banks help RRBs in day-to-day management and finances. Then RRBs can borrow from sponsor banks at a concessional rate at 8.5%. Then the cost of staff deputed from sponsor banks and training of RRB staff is borne by the sponsors bank. Then next one, concession from RBI is also a concession. That means CRR is only 3%, then SLR is only 25%. RRBs can borrow funds through NABARD, ensuring smooth credit flow to rural areas. Okay, now NABARD and its role in agricultural credit. Earlier, RBI managed agriculture credit through its Agriculture Credit Department, providing short-term, medium-term and long-term loans via state cooperative banks and land development banks. This Agricultural Refinance Development Corporation was created to provide refinance support to banks for term loans in agriculture. The focus of credit widened from just agriculture development to overall rural developments. A broader apex level organization was needed to guide and support credit institutions for rural development programs. And how was the formation of NABARD? Yes, it was established in July 1982 by an act of Parliament. Then its function was to take over ARDC functions and RBI's refinancing role for cooperative banks and RRBs. And the ownership was 50% of share capital by RBI. Then Government of India contributes 50% of share capital. That means RBI and Government of India together contributes. Then board composition. How was the board composition? Government of India nominates 3 central board directors. A deputy governor of RBI serves as chairman. And what are the roles of NABARD? It provides refinance facilities to banks and financial institutions for agricultural and rural development. Then it promotes institutional credit flow to rural areas. Then acts as a guiding and monitoring body for rural credit institution. Then strengthen and develop cooperative banks, RRBs and other rural credit agencies. So think of NABARD as the umbrella organization that sits at the top of rural credit in India. It provides funds, guidance and supervision to all banks and institutions that lend to farmers and rural entrepreneurs, ensuring the credit reaches where it is most needed. Now, what are the functions of NABARD? So NABARD inherited the apex role from RBI for agricultural credit, meaning it performs all functions that RBI used to perform in rural and agricultural finance. So the functions are NABARD acts as a refinancing institution. It provides fund for agriculture, small-scale industries, cottage and village industries, handicrafts and rural artisans, and so on. And the goal is to promote integrated rural development. Then, it offers short-term, medium-term and long-term loans to state cooperative banks, regional rural banks, land development banks and other financial institutions approved by the RBI. Then, it enables states to subscribe to the share capital of cooperative credit societies. Long duration can be up to 20 years. Then, NABARD can give long-term loans, contribute to share capital or invest in securities of institutions involved in agriculture and rural development. What about coordination role? Coordinates activities of central and state governments, NITI Aayog, and so on. All India and state level institutions working in rural development, small scale and cottage industries. It also have a supervisory role. That means it inspects RRBs and cooperative banks to ensure proper functioning. Then it maintains an R&D. R&D means research and development fund to promote research in agriculture and rural development. So think of NABARD as a central hub for rural finance. It provides money, guidance, supervision and research support to all institutions involved in agriculture and rural development. Without NABARD, the rural credit system would lack coordination and effectiveness. Okay. Now, Reserve Bank of India and industrial finance. Commercial banks do provide loans to industries, but there are limitations. What are those limitations? They mostly give short-term loans because their deposits from the public are short-term. Then, lending to industries is only a small portion of their total lending. And the problem is that industries often need long-term loans for expansion, machinery and project. And the solution is to meet this need, India has established specialized financial institutions at both all India and state level. So, institutional setup for industrial finance. All India level we have Industrial Finance Corporation of India, which provides long-term finance to industries. Then Industrial Credit and Investment Corporation of India, ICICI, that offers financial and investment support to industrial projects. Then IDBI, that is Industrial Development Banks of India, it acts as a principal financial institution for industrial development. What about state level institutions? State financial corporations that provides term loans to small and medium industries at the state level. Then State Industrial Development Corporation that promotes industrial development in the state by providing financial and advisory support. So think of it like this: commercial banks are short-term helpers, but industries need long-term partners. That's why institutions like IFCI, ICICI, IDBI and SFCs exist to provide big long-term loans and help industries grow. Okay, now let's look at all India level institutions. First one, Industrial Finance Corporation of India or IFCI. So IFCI was the first financial corporation established to promote industrial development in India. It was established in 1st July 1948 under an Act of Parliament, and the purpose was to provide financial assistance to industries to help them grow. So how IFCI provide assistance? Yes, long-term loans, that means loans given for long duration in rupees or foreign currency to finance industrial projects. Then underwriting securities, that means it helps industries by guaranteeing their equity, preference shares and debenture issues. Then subscribing to securities, IFCI itself invests in shares or debentures of industries to support them financially. Also guaranteeing payments for machinery. It ensures deferred payments for machinery purchased in India or imported from abroad. Then guaranteeing foreign loans. It provides guarantees for loans raised in foreign currency from foreign financial institutions. So think of IFCI as a financial friend for industries. It lends money, invests in them and even guarantees payments so that industries can grow without worrying about financial obstacles. Okay, now who can avail this IFCI assistance? Who are those eligible entities? Limited companies, public, private and joint sector. Any limited companies in the public, private or joint sectors. Then cooperative societies incorporated in India. So these entities should be encouraged or planned to engage in specific industrial activities. Then so eligible entities are these ones. Then what are the purpose of financial assistance? Setting up new industrial project, expansion, diversification, renovation or modernization of existing projects. Then concessional assistance for industries in less developed district notified by the central government. So how IFCI raises its resources? Issue of bonds. IFCI raises money by selling bonds in the market to investors. Then borrowing. From Industrial Development Bank of India, they borrow, and from the central bank also they borrow. Then foreign credit. They borrow from foreign financial institutions and international capital markets. So think of IFCI as a financial bridge. It connects industries with funds, whether for new projects or improving old ones. It gets the money from bonds, government and international sources and then channel it to industries, even giving extra help to backward areas. Okay. Now, Industrial Credit and Investment Corporation of India. We can just start the topic and continue it in the next class. So, it was established on 5th January 1955 as a joint stock company. It was formed based on the recommendation of a 3-man mission sponsored by World Bank and the USA government. And the purpose was to channel World Bank funds to Indian industries, develop the capital market in India and so on. Initially, capital was held by private companies, institutions and individuals. Later, nationalization led to majority equity being held by public sector institutions like banks, LIC, GIC. GIC means General Insurance Corporations, okay, and its subsidiaries. So think of ICICI as a bridge between international funds and Indian industry. Initially it was private, now mostly public, and its goal was to bring foreign money to Indian businesses and help create a strong capital market. So we can continue the topic related to ICICI in the next class. So let's stop it for today. Thanks for watching. Hope you understand. For more related contents, do like, share and subscribe.